we've obsessed ourselves with trying to predict the future. Like, people stress about it, and really what they're trying to do is just get rich quick. You know, they want quick and easy money, or they just want to, like, more security. Yeah, welcome to the Money Alchemist podcast, episode number 52. I'm your host, Ben Jones.
And I'm Brent Gargano.
And today we got a lot to cover. There's been some big events since last time we got together 2 weeks ago. It's amazing how much changes in 2 weeks' time.
Yeah. Nobody can predict the future.
Yeah,
right?
I went into my newsletter last week thinking I'm going to write about tariffs, like the bomb, the big bomb news that dropped. And then meanwhile, as I'm typing it up, actual bombs start falling in Iran.
War breaks out.
Yeah. So let's go over some of the changes that have happened since last time we got together. So first, there's a lot of updates here. So, we got, PPI came out hotter than expected. So I don't know if you saw that news.
Yeah.
Yeah. So for those of you who don't know, it's the producer price index. That's the index that the Fed likes to follow because it's like a leading indicator into CPI. So you're instead of measuring consumer price inflation, you're measuring the price of input costs. And it's pretty well diversified, and it ticked higher. So annualized rate was like 3.8, which the Fed doesn't like. So that's one thing that transpired. Employment data came out through the BLS. So wage inflation moved higher. I don't know if you saw that.
Yeah.
So wage inflation ticked up from 3.3% to 3.4%. It was marginal. It wasn't that big. And then
faster than inflation.
Yes.
So I mean, I think the key and it's we over the last few years as clients have reached out. I mean, there's a lot of conversation on how wages haven't kept up with inflation, and I think that's somewhat true. I mean, it's definitely true if you look over long periods of time. But the last couple of years, like since 2000, I think late 2023, wages have on average, and we've got a K-shaped economy, but wages have on average outpaced inflation.
Yes. So PPI actually I conflated the two. So PPI is up 3.6%. Wage inflation ticked up from 3.7 to 3.8. I put it on the screen here. So, that's the January reading versus the February reading. So, in other words, we're starting to see a pickup in wages, which is a little counter narrative to the other things that are happening, like unemployment. It did tick up from 4.3 to 4.4, so basically flat. But there's been a lot of job cut announcements. Most of it, people are excusing it to be like AI related. These companies are, investing in AI.
You see, Block laid off half of their workforce.
I think AI is an excuse because
AI washing. Isn't that what this is called?
Yes. I think companies are basically just trying to trim excess hiring that occurred in the COVID years, and margins are coming under pressure. And the quickest fix to that is to reduce labor costs. So I think you are seeing an element of that, and they're just saying on the earnings calls, it's because of AI enhancements. I have yet to see AI truly replace a human being from start to finish. I've seen it enhance human beings, but if anything, I don't think these layoffs are AI related. In fact, a lot of the pickup is the Kaiser Permanente strike that took place. So we saw a huge unemployment number come through on the healthcare side, which is unusual because that's usually the strongest place for jobs growth is the healthcare sector. And Kaiser Permanente apparently there's a strike going on right now. So, that hit the numbers. Kind of mixed news on unemployment data. The other bit of news that you may have caught on is the news around private credit. Have you caught that?
Blackstone had, I think it was 7.5%. So Blackstone, the largest alternative investment manager in the world. I think they manage $1.3 trillion in assets at this point in total under their funds. In 2021, I'll set this up really quickly just to tell the story. So the year is 2021. Interest rates are zero. Demand for money is super high. Companies are IPOing.
Yep.
There's a lot of demand for capital, and So a lot of these, and meanwhile, you kind of had the rise of these like perpetual alternative investment vehicles. So funds like Blackstone Real Estate, Blackstone Credit, which we're talking about, and a lot of other, plenty of other companies, Blue Owl, Ares, all sorts of other alternative managers offering these perpetual products. Well, because interest rates were zero, these private credit funds looked pretty good. You were basically becoming the credit card to private tech companies and whatnot, right?
And the yields were high. And then the bank, as I understand, banks, it was so attractive, banks which exited the space due to the Frank Dodd Act started coming back into it.
Well, and that's the whole shtick to private credit is like back years ago, if you were a company and you wanted financing, you would go to a bank and they would create this whole deck and you would go through this whole pitch process to go like raise the capital. Well, after 2008, so much of that got regulated so heavily that it became really cumbersome to do these loans and raise this money through the banks. So all of a sudden you have these private companies that raise money from accredited investors, wealthy folks that can afford the losses potentially. And because these people are wealthy and they've agreed to, they effectively are lending the money. And if things don't go well, you're not protected in the same way that your bank account is protected.
Yeah, but wealthy people also like liquidity. And that's what's caused. So you mentioned the evergreen nature of these funds. They're called evergreen funds. They're perpetual funds. So what that basically means is that they're just constantly taking money in and perpetually in existence. And they typically, on average, they have like 5 to 8 year durations in the loans. And these loans are not marketable. You can't. They're private.
Right. You can't go sell them immediately.
Yeah. So what happens is you take your investor money in. Your money's like locked up. And really, the funds are designed to provide 5% liquidity. So basically, if 5% of the shareholders try to redeem it
per quarter, 20% in a year.
Yeah,
that's like the rules that you sign up for when you buy one of these.
So
funds.
what's happened is everybody's collectively panicking. All these investors are panicking. So there's an exodus for these funds. So these funds you mentioned, BCRED, Blackstone's product, BlackRock has a product. Blue Owl, they all temporarily closed down redemptions.
So no. That's actually no. So what happened was Blackstone, they had I'm going to use rough numbers here, but Blackstone had like a 7.5% withdrawal request. So like 7.5% of the total assets of the funds requested to get their money back.
Yes.
And again, like you said, they've kind of only committed themselves. They can what's called gate the redemptions, meaning that if 7% of the people want their money back, they're only going to give back 5%. So each of those people that wants their money back is going to get some prorated portion of their money back, less than what they asked for. But in this situation, and I don't know all the regs to this, but Blackstone, what they did was they actually went to their employees and said, hey, we've got a unique opportunity to raise money. Do you want to buy into the fund? And I don't know if there were incentives, or I'm sure there probably were.
Yeah.
And essentially enough employees pooled capital to get the net withdrawal down to like sub 7, which avoided some kind of regulatory issue, and basically they funded all the withdrawals. So that was the headline, was that they got these surge of withdrawals and they funded all of it, which I think is in some ways a positive, right? Because like the people that wanted their money back all got their money back. But then you have this ongoing question of like, well, what's it going to look like next quarter?
Yeah, exactly. It's almost like feeding a bear. Like, is it a good idea to do that? But the point I'm trying to make here, and I appreciate the detail you've added, is that liquidity matters, and these private non-traded products that were all the hotness in 2021, 2022, now they're not looking so great. So a lot of people are wanting to pull their money out. What I understand too is also there's a lot of software companies in these particular products. So
I think that's really the root issue right now.
Yeah, it's like 20% exposure to software on the aggregate from a recent webinar I attended hosted by Charles Schwab, and that's kind of I think the impetus for the withdrawal request is like, people want to get their money out of it, but investors beware. You can't, these private non-traded products, it's like having your own business. Like it's very difficult to get your money out.
But I want to make something clear, like that could be looked at as a negative thing, but there's also a lot of good reasons that they limit that liquidity. You can imagine if you're a fund manager and you've told all the people that are buying your fund that, hey, anytime you ask for your money, we'll get it to you right away, what have you. Well, what happens if people ask for their money in a time where it's not ideal to sell those assets? Mm-hmm. And we're not talking about publicly traded stocks that you can log into a computer and sell. When you own a private loan, to your point, like these are very hard to sell assets. So what happens is if you promise immediate liquidity on these things for your investors, you could end up in a pickle where basically the asset isn't in a good time to sell and you have to sell it. Yeah. And then the problem is the people that hold the fund are left holding the bag, because now the fund is sold what are likely potentially good assets at just fire sale prices out of need. So the reason these gates, these liquidity gates are in place, I mean, they sound a little scary. And it's not to say that you definitely want to be aware of these things if you're buying these kinds of products, but it's there for the protection of the long-term minded investor, which is what these are designed for.
Yeah. You just got to be cautious of the duration mismatch.
You have to make sure you're comfortable with the fact that this thing might become illiquid.
Well, it is illiquid. I mean, you
there are going to be different times. I mean, I'll give you, going back to 2022, Blackstone's other product, BREIT, has been around since I think 2014 that it was in its inception, and real estate had a mess in 2022 as the Fed yanked rates higher.
Yeah.
BREIT, there was a big story back then about a group of investors out of Asia yanking their money and basically BREIT getting gated. BREIT was actually truly gated, and BREIT has done okay since then. So these things are, again, they're designed to be gated at some point.
Mm-hmm. So, I think we hit that news story on the head.
Yeah, sorry.
You also mentioned, too, a note, which is interesting, is that consumer spending is up 3% year over year. So, which is counter to the consumer sentiment. So I guess Americans are busy engaging in retail therapy. So you're seeing a thriving consumer. And also, anecdotally, that's my experience. It seems like every time I go into a store, whether it be Costco or Walmart, doesn't matter. It's traffic seems solid, at least in the Midwest here.
So specifically, Bank of America puts out. So Bank of America is one of the, if not the largest bank out there. I mean, I don't think they're the largest. That's probably Chase, but Bank of America has a ton of consumer data. They've got everybody's checking account. They've got access to all your transaction data, credit card data, et cetera. So. You can sign up for these things on their website. They have great consumer checkpoints. You just add your email. You get these emails periodically. But the note that came out this morning from Bank of America was that the year-over-year growth rate of consumer spending based on their internal credit and debit card data shows that year-over-year spending growth was 3.2%, which was the highest in over 3 years.
Yeah.
So, consumer, our episode, 2 episodes ago was about consumer confidence being in the twos. But yes, like you said, people are spending their money. They even month over month from January to February, almost a 1% increase.
Yeah, you can always count on Americans to spend money regardless of how they feel about the economy.
Maybe we spend more when we're frustrated.
Might be
Retail
some truth
therapy,
to that,
right?
Yeah, and then the broadening trade that we talked about is happening. So let's talk about that. We a couple episodes ago, I don't remember which one it was, we pontificated the idea that growth stocks, the AI hyperscalers, or Mag 7 as we call them, would sell off in favor of some of the downstream names, the value names that are currently popping off right now. So you're seeing, what were the figures you gave me? Tech was down 3% year to date, and meanwhile, energy was up, financials are up, industrials are up. I think all of them are like up 10%. All these like sectors that are doing well, they seem to all be up 10%. But we're seeing a kind of a reversion in the S&P. Mm-hmm.
Well, and I think what we said specifically was that, like, if AI is going to live up to everything it's chalked up to be, we're going to have to see other companies in other areas of the market benefit.
Yes.
And I don't know if that's all of a sudden we kind of caught that at the right time, or you're just starting to see money flow the other way. But if I look at this, I just pulled up a chart here with like all the several different sectors from the S&P. The worst performing sector in the S&P year to date is software. You've actually got software at negative 16%. Consumer discretionary is almost negative 2%. Technology is down almost 4%. This is all as of March 9th.
Yeah, I pulled up, but I don't know what chart you're looking at, but I pulled one Yahoo Finance up on the screen. It doesn't get that granular. I think software is on here. Yeah, software is right here, but it doesn't give me year to date. But yeah, technology's down almost 4%. Financial
regardless, essentially
financials are down. So I was wrong about that. But yeah, if you look at healthcare's up, industrial's up, consumer defensive up, energy up.
Well, yeah, I mean, it's basically the everything else trade. I mean, we talked about this a few times. This is why it's so important to have a diversified portfolio. I wrote my last newsletter on the importance of a diversified portfolio. People get so frustrated on the way up having a diversified portfolio because they don't only own the winners. But the reality is it's just important to be invested all across sectors because ultimately what happens is things mean revert. And it's just a great example. I think the S&P from the peak is down somewhere in the neighborhood of 3% right now, but you've got software stocks in like a 30+% pullback.
Yeah.
Tech stocks are down 4%, whatnot. So it's just 4% on the year. So it's just really important, or it's been so great to see the index provide a level of cover while there's all this churn underneath.
We also want to look at international stocks too. There's been a big pullback. And this kind of ties into what we're going to talk about today. So if you look at, I pulled up on the screen the iShares Core MSCI Total International Stock Fund, and at one point it was up like over 12% year to date, and then it kind of tanked. It's still positive year over year. So if you look at year to date, it's up 5.43%. But it was up pretty good for a while. We saw a significant pullback, which leads into our kind of topic du jour, which is let's talk about Iran. Like, my God, what the hell's going on there? So we woke up a couple Saturdays ago. I don't know how you found out the news, but I was getting my morning coffee Saturday morning, and then I pull up my phone to sit down on the couch, and then I pull up X, and then the first thing I see is, this news story that the U.S. attacked Iran, and I'm like, what is going on? And I scrolled down. I kind of got into a doom loop there, and that whole weekend, I'm just thinking, holy cow, Monday is going to be nuts. Monday is going to be, my phone's going to be ringing off the hook. Anecdotally, guess how many phone calls I got Monday morning to talk about Iran?
I would say zero.
Zero. Absolutely none. Nobody cared. Yeah. I don't know what to make of it. I wrote in my newsletter last week that went out, I basically said, we're just so inundated with news that we're kind of getting numb. Yeah, we're getting numb to the buzzwords. We're ignoring what's going on. I actually did I'll pull up my my newsletter real quick. I created a chart. Like, this is this woman just cooking dinner, urgent broadcast, fire going on, evacuate now, and she's just happier than ever. Yeah,
ignorance is bliss.
Yeah, and that's kind of what's going on.
We are so lucky that we are in America and isolated across from some of this stuff by oceans. I mean, it's like moments like this, you see people in these other countries that are like getting bombed, and I mean, it's heartbreaking.
Yeah, you watching the videos, the reels of people like filming outside of their houses, and there's giant explosions going on. I tell you, I've got mixed feelings about the whole Iranian conflict. Operation Epic Fury, as they've called it. Frankly, I just can't get behind yet another military, operation in the Middle East. So emotionally, I'm a pacifist when it comes to this stuff, and I'm just like, oh boy, here we go again. But let's take a step back from that and just look at this pragmatically through an economic lens. That's what we're going to try to do today, is really touch on what the Iranian conflict means for your portfolio, and what these geopolitical moves are going to likely do. We don't know for certain, but you and I can speculate together. I think we can wrap our heads around, what the consequences of this could potentially mean economically. And I think you had some stats you wanted to share on, prices of oil historically and how they've impacted the S&P 500.
I think the natural thing, you mentioned that you got 0 calls from clients. I didn't get a bunch of phone calls. I did have some conversations I was kind of already having incidentally, and this came up in those conversations. And, one thing that I found interesting is a lot of times, and just going back to my past career, when I used to work at Fidelity, that was when you would really get nervous over the weekend about what was going on, because you'd go through the weekend seeing something like that, and then you'd have to show up to work, and you have people's retirement accounts, and they're just calling you, and you were answering a lot of questions about how should I invest my retirement account, and so you'd get somebody that would call you that just had a Fidelity 401k, and they didn't have a financial advisor. They're trying to figure all this out on their own, and they're just like, look, I've been a little nervous for a while now. This is kind of the catalyst, so to speak, that's going to get me over the edge and force me to make me think about selling out.
And I bet there's a lot of retail investors having that crisis moment right now. I didn't personally experience that, with my clientele, which I found surprising. It surprised
Your
me.
clientele have a financial advisor.
True.
They kind of, one of the things that we do as advisors that's so important. I mean, people forget that sometimes the most impactful thing an advisor can do is just set your expectations and help manage your expectations in a way that allows you to be successful. And one of the most important things that you can learn to be a successful investor is, how do I manage my expectations so that when the market actually sucks, because markets go up and down. It's part, and volatility is a feature, not a bug. That you can have the emotional fortitude to stick with it, and the situational set. It's important you make sure that you're not investing money that you'd have to yank out in that situation.
So the first and most obvious consequence to this action is oil. Everybody's freaking out about the Strait of Hormuz being shut down right now. You were mentioning earlier, imagine being a captain of a ship, and then you're in the middle of the strait, and then this operation takes place. You immediately shut off your transponder and turn off all the lights in your ship because you don't want to be the target.
Well, I think that was actually happening.
I bet it was.
From what I heard, there were actual ships that were already on their voyage that needed to get through the strait, and this was early on in the conflict, and they just turned off their lights and made their way. Can you imagine having to do that?
No, I'm glad that I have a comfortable job sitting right here podcasting and
your whole
running
boat
a
is basically a bomb. You're filled with oil. I don't know. It's kind of nuts.
The natural gas is a little more sketchy. The oil isn't super flammable. Well, it is. It'll burn slow, but it's not explosive.
Oh, well, either way, I don't know that I would want to be on a boat that's burning slowly.
Well, so what's happening here, the media's covered this ad nauseum, so I'm almost hesitant to do it again. But I feel it necessary because there might be some listeners that aren't really keeping in tune with what's going on day to day. So the U.S. basically went in with Israel, and they just demolished anything that was Iranian military, and that, from what I can gather, is absolutely true. You never know what quite to believe. There's all this propaganda, but there's lots of supporting videos showing they're flying B-52 bombers over Iranian airspace. This is a 1950s airframe that has the ADAR or the radar signal of a giant Pentagon building itself flying in the air. It's super detectable, and they're just flying these things over Iranian airspace. So obviously the military is severely diminished. So, but what's happening though, as I understand it, and again, I'm not in the know here. This is just me reading the news stories. Is the Iranian National Guard Navy Corps is basically on the beachheads, and they've got these fishing boats with these cheap drones, and they're just threatening. They're just threatening the ships. They're saying, "Don't you dare cross. We'll go out there, and we'll send a swarm of drones after you that the U.S. can't do anything about." And that fear. Now there are I could get a firm number on this, 3 to 5 ships that have been actually hit. So there have been some examples made of. But that's enough scare for these ships to say, yeah, let's not do it. And then the Lloyds of London pulled their insurance contracts. Right. And that's just enough to shut it down. So it's just a giant game of chicken right now. So the Trump administration came in and said, oh, well, you know what? Screw the Lloyds of London. We're going to insure it over the strait, which I don't know the mechanics of that, like how that actually works. Because that seems to me like the United States government isn't set up to be an insurance company. So the Lloyd's of London has been operating for centuries. I don't know how the government can just come and like replicate it, but maybe there's some like loose contract, like the Paycheck Protection Plan, that can be initiated on the fly. So I'm sure there's something like that, but it apparently hasn't resulted in any increased traffic through the strait yet. So right now we're just in a wait and see mode. I think what ultimately will happen is that ships will start getting desperate, because you got money on. I mean, we're talking billions of dollars here of trade. So eventually, these exporters are going to say, you know what, enough's enough. We're just going to risk it. The U.S. says they're good for the money. They've got these what do you call it when you when you tail someone? There's a word. Escort. Golly, I wanted to say export. I got export stuck in my brain. So you're going to have U.S. escorts, and I think eventually they're just going to call the bluff and start opening up. But I think we're going to see heightened oil prices through the summer because it's going to take some time for the financial pressures of this all to build up.
Yeah. Mm-hmm. Yeah, I think that's what's really bugging the market, because like go back to where we were last year. We did a podcast on this. We were looking at oil. I think back in December, oil was breaking down below $50 a barrel. You had inflation in the mid 2% range.
Yeah,
and you have.
I got the contracts up. So you said December, right?
Yeah, I mean, it doesn't take. I mean, I don't need to show you a chart to show you how much it's gone up since then. Oil, I think, is up from like $50 a barrel. I mean, it peaked out over $100 a barrel the other day at peak.
Yeah, I'm looking at the New York Mercantile here exchange, and it peaked at like 98, I think.
No, I mean intraday it was over 100. I mean it opened on
these
Monday.
Are closing prices.
It opened on Monday over $100. So the bottom line to it is like this changes the narrative. I think before there was this kind of narrative that okay, inflation is coming down. A lot of the biggest drivers of inflation we can see are calm, and employment is starting to be a little bit rockier, slowing down. And now, and that was, by the way, that gave the Fed room to cut rates potentially. Like that was what everybody was excited about coming into the year. We're getting a new Fed chair. We've got Kevin Warsh coming in.
2%. 2%'s around the corner.
By the way, then Kevin Warsh got appointed, where he got nominated, and we've heard nothing from him.
Yes.
By the way, so we have no clue where his actual head is on this. And then besides that, you've got the inflation narrative really being challenged. I mean, with oil going up to $90 a barrel.
Yeah, and this is coming on the back of a PPI reading in January that was hotter than expected.
Yeah, so I think it's just a lot harder to kind of support the narrative of like inflation's dead, let's cut rates. And so I just think that this is one of the things the market's trying to grapple with is like, what is the implication of the Fed's path given what's going on with oil? And the Fed, like for the last year, the Fed has talked about the impact of tariffs on inflation and how they want to look through that. Like they're going to ignore the tariff effect on inflation when it comes to their rate path decisions. It'll be, I mean, historically speaking, they've also said the same thing about oil because it's like they ignore like what they consider to be like one-time price shocks. But the hard part is like they're already ignoring tariffs, and then they say they're going to ignore. Like, at what point do you look down and go, okay, you can ignore everything that creates inflation, but there's still inflation?
Well, tariffs kind of already priced in. I mean, we're reaching that 12-month rollover period, and tariffs are only going to get softer.
Yeah, I agree with that. I'm just saying that like they're already trying to like explain away why they're not as concerned about inflation, and now they've got to do it for a different reason.
Yes.
And I just think the story starts to feel tired.
Yeah.
And it starts to limit the credibility of the Fed.
Well, yeah, that's what I was going to get into. It's almost as if the Fed is political.
Well, I don't know about political one way or the other, but like I just go back to, I just remember 2021 was just such a good example because the Fed, I mean, here we had, it was so similar to this in the sense that you had like tanker prices going up. You had all this inflation in commodities and it just hadn't shown up in CPI yet. Mm-hmm. And the Fed sitting there talking about how it's, the word of the year was transitory. And God, did Jerome Powell get burned for that word over the next few years. And it's like last year we started to hear the word transitory again, related to tariffs this time. Mm-hmm. And now are they going to say that about oil?
So, one thing that is different this time, the last oil spike that we had that resulted in a recession.
It's like early 1990s, right?
No, it was 2008. You don't remember that? 2007, we had oil shocked up to $150 a barrel. So we have had something called the shale revolution in the United States, where now if you look, this is U.S. Oil consumption is in the red bar here, and production are these horizontal bars. All right, so we are a net export nation, meaning we produce more oil domestically than we consume. So, this is going to put a cap on how high oil prices can reach. So, from what I understand, I'm not an expert when it comes to oil production, but a lot of the frackers really like oil above $60, $70 a barrel. That's where they shine. And apparently you can more easily activate wells. You can turn them off. It's not like oil where you
the
pop
economics
a cord.
make more sense.
Yeah, so it kind of acts as a buffer. So if you've looked at oil prices over the past several years, they're really kind of, you have these spikes, but there's an upper ceiling to how high they can go here. What I'm trying to say here is that I do agree that if Kevin Warsh or whoever is using the term transitory, I do agree that it potentially could be transitory. Where it's not potentially transitory is if this conflict lasts a long time. And I'm not willing to make that bet because we've got midterms coming. Trump has to know. He has to know that war is not popular. He ran on a no war president. So much for that. Yeah. So he knows his base probably doesn't want a protracted war. They want a George H. Bush, who is that? His middle name.
This is what I was
They want
bring
an Operation Desert Storm. Go in, kick butt. That's why they named it Operation Epic Fury. A little on the nose, right? Obvious. So they came in with shock and awe, and they want to hit hard, get the hell out. And I think that's probably what's going to happen. And, Trump is also, he's very narrative driven. He's not so much results driven. He's very narrative driven. So the mission objectives of this whole campaign are very ambiguous. They've never really named any. It's a regime change. Well, what's that mean? Do you want a democracy
the guy's
over there?
Son is now in.
Yeah. So, I think really let me step back and I'll tell you what I think the objectives are. By the way, I don't think it's Trump that's behind this. I think he kind of got dragged into it, and he's spinning it the way he's good at. He's good at spinning narratives and stuff. I think what happened is the Pentagon's they've acknowledged this. They're running like super advanced war game scenarios, backed by AI. You've heard the stories of Claude and the Pentagon fighting like
Anthropic.
Anthropic, yeah. Well, that's Claude, right? Anthropic's behind Claude, as I understand it. So so they're running these complex AI scenarios, and they probably are constantly doing that and all, running all current geopolitical events. And there was probably some sort of green light that occurred. Who's Marco Rubio kind of clued us in a recent news broadcast he did. He basically said, look, Israel was going to strike. They decided to do it. And that they probably took that data entry and that went into this war game scenario, and it triggered okay, this is what you do. We have to do this. This results in the best outcome. So the Pentagon probably sat the president down. Again, this is all speculation.
Yeah,
this
total
is
conjecture.
Conjecture is me thinking logically this is how it would break out. And then a decision had to be made. And I think the decision was, okay, green light. And really the objective was to maintain dollar hegemony. I think that's really what they're trying to do. Because if you look at the Venezuelan actions, you look at the whole story around Greenland, like what's that all about? Like, it's all about energy. It's all about oil production. And what we've seen globally happen is, oil is starting to trade outside of the dollar system that Henry Kissinger set up during the Gulf War era. And that's really what kind of created the dollar hegemony, is the fact that all oil pretty much traded in dollars. Mm-hmm. All right. So what happens when now Venezuela and Iran are trading their oil directly to China for yuan?
Right.
It completely subverts the dollar system and reduces dollar demand, which makes it harder to sell U.S. debt. So I really think that that's what this is kind of about, is, how do we maintain dollar hegemony? How do we continue to sell U.S. treasuries? And I wouldn't be surprised if this somehow ties into, this whole stable coin talk that we're hearing, that's supposedly what's this act that's going through the system right now? The banks are fighting. Yeah, the Genius Act. No, it wasn't the Genius Act. There's some other act right now that's being held up in Congress because the banks are lobbying it, because it kind of cuts them out of the transaction fees. But anyway, the Genius Act was already passed. That kind of paved the way for these stablecoin markets, and stablecoins like Tether are backed by U.S. Treasuries.
Supposed to be.
Well, as I understand it, they are. And I guess I take it.
Tether in particular, I think a few years ago, turned out it was a big scandal. They didn't own enough treasuries to actually back it.
Yeah. So
broke the buck, so to speak.
Anyway, take a step back from the geopolitics of all this. I do think that this is going to be kind of a more like the Gulf War. It's going to be a short, quick, lightning fast type of situation, and then the U.S. is going to pull out and they're going to delegate the maintenance mode to Israel. That's, I think, what's going to happen. And then the Strait of Hormuz will probably open back up under a new paradigm. And we'll see oil markets stabilize. I think in the interim, we're going to see oil markets capped largely by U.S. production.
I mean, part of the reason that oil shocks or oil price increases are so scary is that, historically speaking, there absolutely are recessions that were caused by oil price spikes. But in those, the argument is that in those periods of time, the U.S. didn't produce as much oil. The reserves weren't as big. We relied a lot more on the Middle East, and that's just not the case anymore.
Yeah, that's also why we're seeing energy markets year to date. I mean, they're the number one performing asset.
Well, interestingly enough, you're right about that.
Not number one performing sector of the S&P.
Yeah, so year to date, the energy sector of the S&P is up like 26%. But here is the odd part. Going back to the taking phone calls at Fidelity, you'd come in after the weekend, and what do you think if the people were calling me about buying anything in their 401ks, what did they want to buy after the war broke out?
Oh, they want to buy energy, right?
Energy and defense. Yeah. So what do you think energy stocks and defense stocks have done since the war broke out?
I bet you they're down.
They are down.
Yeah.
They are negative. You know what's up? Technology and software, everything that is sold off.
Yes, and we brought up this story about software the other day. Remember the story about Claude? What's with Claude? Claude's like,
they're all
making
over the
all
place.
sorts of waves.
They were that big Super Bowl commercial. Now the government's frustrated with them, and
well, they're also the ones that are gonna. The news story came out with Citrini. Citrini. Yeah, sorry.
Yeah, you like to throw the N in there.
Yeah, I do. I don't know why.
I'll be the one that corrects you. It's okay.
Thank you.
for the listener that's going to sit there and get PO'd at their computer.
All you got to do is prompt Claude, and it can create a whole software package for you. Software was dead, was the notion. Software is not investable, and all the software companies like Adobe, I would imagine, was in the mix. What else would it be in there? Anyway. You know what I'm talking about.
Salesforce, ServiceNow.
Yeah.
I mean, just all sorts of companies that, like the prognostication is that you can now use AI just to create the who needs the software as a service provider. So the term for this, there's apparently a new term for this. It's the SaaSmageddon.
SaaSmageddon.
Yes,
I get it. Yeah.
So
SaaS is software as a service.
Software as a service. That is, and for years, the last 10, 15 years, that's been one of the hottest places to invest as software has increased our productivity significantly. And then the odd thing is now we have AI, the ultimate productivity enhancer. And the question is like, will it kill software? I don't know. My belief is that this is why I own diversified funds, because there absolutely will be software companies that are obsolete because of this.
Yeah, and I think that's kind of the message of today's episode is the importance of diversification. It's fun to talk about all these sector, which one's outperforming, which one's doing well and why, but you should only really consider that through an historical lens. Like moving forward, unless you want to be a type of contrarian investor. I read an article or post the other day that said contrarianism is overrated.
Yeah.
And, because it's very difficult to be contrarian because you don't really know like what you should be betting on. The future is so opaque that
it's unknowable.
Yes. And there's so many variables. Our economy is incredibly dynamic. It's very fluid. That's why I don't think there is ever such a thing as economic fact. There's only economic theory because economics is constantly changing. We've got all these competing arguments. There's you got the capitalists arguing there's never been true capitalism, and you've got the communists saying there's never been true communism. Well, the fact of the matter is, the economics are so dynamic that you can't predict what's going to work and what doesn't.
You've heard of the butterfly effect, right?
Mm-hmm.
I mean,
Yes.
the concept being that like one little change can influence so much about the potential future. So I heard a story not that long ago. It was about World War I and Franz Ferdinand.
Yeah.
Did I tell this last podcast? Did I tell this story?
No, go for it.
So my understanding, again, my understanding is that World War I was started by the murder of Franz Ferdinand.
Yeah.
And I guess the guy that shot him had originally taken a position up on a building or something like that and had a shot down at the guy and took the shot and missed. And after he missed, he was trying to get away. And so he's walking in the street and he ends up walking up to a street corner. And at that very moment, Franz Ferdinand's what would you call his
cart, his buggy.
His buggy pulls up. And so all of a sudden, the guy that was trying to assassinate him is right next to him on a street corner. So he pulls out his gun and shoots him.
Yeah.
Right? It's like
That's bad luck.
it's like, and that was the catalyst of World War I. Like, what if the guy had turned the other way? Like, sometimes history boils down to like, what direction did you choose to turn on the sidewalk?
And people will be like, "Oh, how do we trade that?" That is an untradeable
know
outcome.
that.
Like, there's no poly market out there that's going to predict that outcome. Like, I really think that, we've obsessed ourselves with trying to predict the future. Like, people stress about it, and really what they're trying to do is just get rich quick. They want quick and easy money, or they just want to like more security. I think some people are trying to predict the future because they don't want to be a sucker.
I'll tell you what I think drives a lot of it. I think a lot of it is fear driven. I think there's a lot of people out there that are far enough along in their career to kind of see their potential for retirement, and they feel like they're behind. And what happens is you start reaching. You start trying to get cute, as I like to call it, to try to drive return. And in doing that, I mean, what I've seen in the past, in doing that, you can cause yourself a lot. Like, all of a sudden, you end up taking a position with more risk than you should have taken because you're trying to get yourself ahead or caught up, so to speak. And then when it doesn't work and you're further behind, now the drive to take riskier bets, it's getting bigger.
Yes.
And so it's just not like, you want to make sure that your financial plan is a plan, and it is not based in luck, like you happening to pick the next hot stock or hot sector. And it's based in reality, and it doesn't anticipate the market never going down or things like that. I mean, good plans account for the reality of the world, which is that markets are volatile. You can't control, individual stocks that you own. And the quicker you can get comfortable with the idea that you don't have control and you can't predict the future, the better you're going to be as an investor.
Yes.
The dumber you realize you are, the more effective you sometimes can be.
Yeah, it's like that meme, the bell curve.
I'm not trying to call people dumb, but
yeah, you got that, that bell curve where you got like the really dumb person, making the same conclusion as the really smart person, and then in the middle, everybody's acting dumb, or doing the wrong things. Our most successful clients, without exception, I can't think of one exception, legitimately. None of them follow get rich quick schemes. None of them try to get cute. They adopt a very boring asset allocation. It's not sexy. There's always a portion of their portfolio that they hate, and they ask us about, like, hey, what do you think of that? And we say, hey, own it anyway. International being the example of the last 10 years. But what they do consistently is save, and they save through a 401k or payroll deduction. They're just consistently saving. And they do it regardless of the news. They do it regardless of what's going on in Iran, whether the tariff policy is good or bad, whether there's a war going on in Ukraine or not. No matter who the president is, they're consistently saving, and they own assets. They own natively scarce assets that function, that serve a social utility. That's what you do, and it's not get rich quick. It's get rich slow. We talked about Warren Buffett, where he was 60 when he was 65. I think he was worth like 10 billion or something.
Yeah, it's like 3.5.
Yeah, 3.5 billion.
He's
and
like
then now he's worth
140 or something now.
Yeah, 150 billion. I think he is. So from
it's
age
not because
60,
his returns got better. It was compounding.
Yeah. So the guy took 65 years. The Oracle of Omaha, 65 years to get 3.5 billion, which that's a lot of money. Don't get me wrong, but from 65 to 90, what is he? 99. I know he's 98. He might be.
Well,
90.
he's not that old, I don't think. He's in his early 90s.
Okay, early 90s.
I have a great chart on this that shows, like, if you save $10,000, it's just simple math. Okay, you save $10,000 a year for 40 years. I'm not looking at this in front of me, so don't quote me on the exact amounts here. But if you save $10,000 a year for 40 years, you earn an 8% return. You end up with something like $2.6 million in the account, give or take. And if you look at over the 40 years of time, the first 24 years, you only see 20% of your total growth. So think about that. You've got a 40-year career. You're 24 years into it, which is like 60%, if I did the math right. And you've only seen 20% of the total gains and growth in your assets.
It's like the amortization calculation.
Like, let's put that in years, okay? You start working at 22 years old or 25 years old, and you start saving $10,000 a year, just to follow the example. 20% of your return, by the time you turn 49, almost 50, you've only seen 1/5 of the returns that you're going to see between 25 years old and retirement.
Yeah.
Right? Just mathematically. Okay. So it's like, from our perspective as an advisor, working with a lot of clients that are in their 30s and 40s and kind of in the middle of that 20%, it's so hard to like help them see that, because everybody wants to become wealthier. Like, that's the reality, is that people want more money, and you've got, like, they're still making a lot of money, but they don't quite, like, it hasn't quite hit them, like, just how much this compounding is going to impact them later. Because 80% of the returns come in the last 40% of the time.
Yeah.
So one other thing I'd like to mention, just for a little bit of optimism here, in terms of, we talk about not market timing, and I'm sure for most people listening out there, if you're invested, which I assume most people are, there's a lot of things out there that could be driving you to be nervous right now, between wars, inflation, AI bubbles, cryptocurrency, all these different things. There's a lot of churn. So I pulled a stat. This is from a blogger that I follow. And looking here, it's basically the last, since 1990. So basically from 1990 to 2025, they looked at every time oil is up more than 5% over 2 days, and then what the stock market did as defined by the S&P 500 over the next 1, 3, 6, and 12 months. Okay, so how does the stock market do after big rallies, big oil price increases? The average return, just cutting to the point here, the average return in all of these 13 scenarios, 3 months out is 4%, I'm rounding, 6 months out, roughly 8%, 12 months out, 23%. The only exception to this was in like 2008. Basically, you had from September 22nd of 2008, you had some negative periods, but overwhelmingly, well, in 2022, but again, that was not oil, that was the Fed raising rates. We had 17 rate hikes in 2022. So, long story short, the data over the last 45 years would tell you that oil going up a lot is not a reason to uninvest.
Oh, absolutely. Yeah. So, for everyone listening out there, keep your chin up, keep diversified, keep saving. Nothing new here. It's exciting, flashy news, but you should technically be on that image I showed of that woman with the
that
fire in the
woman's doing
background.
great.
Yeah, that's who you should be. So, well, let's end on that and then shift over to the tip of the day. I've got an idea, unless you have one. Do you?
I think yours is great. It's the weather is getting. I'm just going to say this. I am very seasonally affected. Like, I am one of these people, and I'm sure I'm not alone in this. Like, once the clock changes in the fall, and all of a sudden it's like the days are shorter, it gets dark at 5 p.m. or whatever. It's just hard to want to go outside and like do stuff. And then all of a sudden, this past weekend, the time changed again, and now it's light till like almost 8 o'clock, and I love it.
Oh, me too. I wish we could keep this time.
Why?
The daylight savings, I wish was the permanent time.
They talk about that. I mean, that is something that seems to come up all the time.
Well, the health
Didn't
nuts,
Trump talk about that when he was running for office? Because it's like an 80-20 issue, apparently.
We can't agree on it. It's like it is the hottest, it's the most contested issue. I think it might be like more contested than like immigration or whatever.
Daylight savings time.
People will not agree on this. So the early risers, what I find out, like I follow this guy, Andrew Huberman, on
Huberman
X.
Labs.
Yeah, Huberman Labs. And this guy will die on this hill. He is going to say daylight savings is bad because he's such an early riser. The guy wakes up at 5 a.m. He's got this routine. He like soaks in the sunlight. He like has to watch the sunrise. And
that is the one downside is I get up at 7 a.m. now and it's pitch black out.
Well, but he would think that that's good. So, but what he likes is he basically doesn't want to wake up later. That's what it amounts to. He just doesn't want to shift his schedule. That's actually what this all boils down to is people just don't want to shift their schedules. That everybody's just competing for like, there's some people that their schedules do better under daylight savings and there's some under standard time. But anyway, I do better because we have banking hours. So we love the daylight savings.
Don't you just feel so much happier when it's nice outside? I mean,
Yes.
I don't know how you could live in some of these countries where it's like dark for 18 hours a day at times. So this is all to say that I think your tip is related to travel, and I think everybody's probably dying to get out of the house right
everybody's
about now.
like looking, if you're like our household and you're probably right now looking, okay, what do we do for the summer vacation? This is when everybody's booking. And realistically, the best time to book your vacation is probably 12 months in advance, but a lot can happen in 12 months. So it's really tough to like book that far in advance. So a lot of people kind of wait until really about 3-4, at most 6 months prior. So something that we've done in the past that worked out really well, again, is a Costco tip. I know people are getting sick of the Costco tips, but Costco's popular for a reason.
Anybody's getting sick of Costco.
We love Costco. I'm
certainly not sick of Costco.
We're definitely nerdy about it. All right, so what we did, and you can do this anytime, but when we did it, we took advantage of a temporary promotion, and I bet you can research it, and Costco might still have some like unadvertised promotions. But the function of it is this: we use Costco Travel. Costco Travel is it's a legit travel agency, pretty good. And they sell travel packages, like resort packages. I looked up a package prior to this podcast of like a Maui trip for 2 weeks, and they range anywhere from like $15,000 to like $25,000, depending on how you want to do it. So it really this method works really well for those like high dollar vacations that you're planning on. So, I got a family of 6, so every vacation seems high dollar to me, but
just getting them flown over there.
Yeah, it's a big deal. So, what we did, we planned on going to we went to the Bahamas. That's what we did. And so, I saved for this. It was a item in my financial plan, and I saved consistently for it. But when it got time to put the money down, we called Costco. We enrolled in the City Card. All right, I'm kind of an anti-credit card guy, but mostly for like everyday purchases because I think there's a temptation to overspend because you're spending tomorrow's money. But when it comes to like these one lump sum purchases, absolutely, abuse the promotions if you can. And so we caught City Card at the time. They're not running it right now, but people keep an eye on it for it. They were running like a temporary 10% cash back on travel through City Card. Through the Costco City Card specifically. And on top of that, we bought the Costco Executive Membership, which gives you 2% back on purchases. And then on top of that, the City Card had their standard offer, which is I think it's 4%. I think it's 4% on travel. Yes, that's correct. Oh, no, 3% on travel. Sorry. So standard, you can get 5% if you just do the executive member plus the city card and you book through Costco Travel. That's a 5% cash back on a $20,000 vacation. That's $1,000.
Sure.
$1,000. Now it's Costco credits, but back when we did the,
you're gonna if you have a family of 6, you're gonna spend that $1,000.
Why? Like it's a free $1,000, and plus Costco Travel, like the
was competitive.
Yeah, the prices are very competitive. Like you
check Trivago.
I checked all of them, and Costco by far was the best deal. Now also too, when we booked it, the city card is running that one-time promotion, which again, you can probably call them. We had to call them to get this. And that's another thing you should do. Call. Don't book it online. Always call, chat, talk to a real life person, make them beg for your business. So my wife spent hours on this, but guess what she got? $3,500 cash back. Costco, I shouldn't say cash, Costco credits, because they're store credits. But then she went and bought a whole new washer and dryer. I said, lucky you. But yeah, it was a great deal, and I think people should people overlook that.
And I'll just add, I mean, not that it's maybe it's a similar tip, but we may have said this before, but anytime you have a credit card, make sure you read the benefits guide. There's so many benefits in these things that especially like for travel. I mean, a lot of these cards offer baggage insurance. So if you lose your bags, they'll pay for you. If you get stuck somewhere and your flights get delayed, they'll pay for you to stay overnight at a hotel. I mean, one of the things that I see time and again with clients is just simply not knowing what benefits their credit cards offer. So a lot of times you can just download the apps on these things and kind of flip through the rewards section and find all sorts of good stuff.
Yeah. All right. Well, there we go. That's episode 52. For those of you who stuck around for the whole episode, we sincerely thank you. If you liked, please share this with your friends. Support our work. We're trying to grow our listener base. We really appreciate each and every one of you. And we look forward to episode 53 in a couple weeks. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.